GetCrack. Wake up, motherfucker.
All right, what's up? All right, okay, this is nighttime Friday, July 17th. Oh, well, the market didn't go as deeply as I wanted to, so I didn't show up in the day. But I did buy some stuff, not as much as I would have if we dropped more, okay? So let's review certain things. Let's get the chart going. I gotta go find something else. Damn, I had to download something too. Let me see. Crap, where was it? Let me see. Let me see. Let me see. Okay, got that. All right, try to download this. All right, this thing's loading. Okay, let's get this going. Come on, come on, come on, come on, come on, come on, come on. Download. All right. Okay, that's downloaded successfully. Okay. Alrighty, guys. I'm gonna play this clip for you first. So this is what I was talking about last night. So let's see what I said. All right, and I said, let's see this. Let's go here. Intel. Okay, and I think yesterday, yeah, I said like something like, yeah, it's gonna be, we're gonna go below, right? And then I'm gonna be looking to buy. That's what it is. We're not much below where we were in the bottom during June 5th here. Okay, this area here. And then we retested it again on June 9th. Okay, not too far away from each other. Now we could, since we've gone a lot faster, a lot deeper, it should be a lot easier to scare more people by making it break down to 85 or 80, and then it will rally up. So you should be able to see this within 1 day. I would think 1 day, one single day, you should be able to get something. Okay. Oh, my bad. Let me zoom out here. I forgot this thing is like all zoom. All right. So that was my prediction for Intel yesterday, right? I was expecting us to V up. Okay. Yeah, we did in the morning. A lot of stocks did that this morning. We were down. Pre-market was going about maybe 2% on the Nasdaq, I think, and we moved back up. So okay, that's something. I was hoping for a deeper bottom, really. Like this thing could last all the way into the afternoon today into Monday. That was what I was hoping for. I was hoping for a lot better uh downturn, you know? That would have been nice. I could have picked up a whole bunch of stocks. But okay, whatever. I got Intel, I got SanDisk, I got Micron. I forgot some other ones like HUT, NBIS. Uh, yeah, the stuff. Yeah, I think that was it for now. Rocket Lab didn't really go down that deeply. Qualcomm, STM, um, Nokia. Yeah, well, I didn't want to overdo it. I guess I could have got those three too with them, but that was it. There wasn't really much of a shopping today. Yeah, STM, that's like you see here the weekly, that's pretty good, right? That's pretty good. Pretty good tag there. Maybe, I could have added that, but I think that was fair. I think that's fair. Nokia, I was hoping it was get closer to 8. It's still hanging around 10, right? So this is what I drew, huh? See, something like this. Something like this would happen. Next week we'll have earnings. Okay, next week we're gonna have earnings on ST Micro, STM, and Nokia and OK. So, I mean, that's kind of risky for me to get Intel with those two as well. Maybe it'll work out. Maybe it'll all work out. Maybe that's just what's gonna happen. It's just too tempting right now. It's just too tempting. Everybody pushed this thing all the way up after earnings, and we're back to where we are before earnings, right? This is earnings week right here. Earnings week right here, and we're right back at the same level. Why not? I mean, why not? Why not get these things? But I was hoping for deeper. This one, no. If we want to get back to earnings level, we have to get the 52, right? At least 52 on STM. And let's see, Dell. Dell was pretty good too, but I didn't pick up any Dell. It has this nice range on Dell. Very good. Very nice. But I didn't pick it up. I mean, I don't see a reason why not, right? So yeah, there was a lot of things you could have got for shopping today. Let's see, Band. That was the risky one that I told people that the chart looks the best. Yeah, the chart still looks very good right now, right here. Very good chart here. Look at that MACD. It's making a duckbill shape. Very nice. Very nice. So we've survived this. We moved that. That's good. We're over here, back here on the top of this, the top upper black line based off of this candle in June 1st. Yeah, very good. Let's look at the Twilio. How's that one doing? Yeah, not really. Yeah, you see, like if we had a bigger drop in the Nasdaq and the S&P 500, this thing could have just went down here today, right? And you would have been like a lot of stocks would have had a nice deep push down where you could be like, "Oh my God, I'm getting a great deal." Everyone's panicking, but yeah, we just had a little blip in the morning and then just recovered within 30 minutes. So if you look at the Nasdaq here, the index level on Nasdaq is at the bottom of its range. Perfect time to buy, right? You would think. My thoughts were that it just did this, like really try hard to scare people. And if we had a big drop today that continued into Monday, let's say we could have maybe got about a good 4 to 6% drop. That would really flush people out. That would give me more confidence when we do bounce from that level. It's a solid bounce that could restart like the trend. Okay, we need to restart the trend right now. We've been dying here. This sideways stuff is slowly killing it. It has to resolve. Either it just breaks up, which it hasn't done, and you kind of do this dangling action where the Nasdaq is at the edge of the cliff, ready to break down. If this thing doesn't come back in like strongly, my fear is that it's just gonna weakly attempt this and then go back down. It'll just go back down. It'll just be like, and then it'll just drop in a later date, like towards August when a lot more earnings comes out. That's what I'm afraid of. I'd rather see like it get a lot of shakeout here first, so that when you have earnings, it's better than expected at this price, right? When you're at a higher price, you're expecting a lot more from earnings. But if we knock down and pop the bubble a little bit more, because Micron, SanDisk, they're still like high expectations. The expectations of those stocks are still too high for me to say like with confidence, oh well, it's a good idea just to buy these stocks um, with force because I'm not gonna put more money into it. Like this thing is just like I'm just gonna put little bits of money right now. You gotta really give me a good reason to put money in before we get earnings. Like I don't do earnings unless you give me something that's very attractive, right? It has to be very attractive for me to really say, yeah, it's worth it. Like if you look at Air, yeah, this thing was more attractive. Sure, I would play it, but then, I already made some profit already from buying it in these earlier stages. So I'm willing to gamble a little bit here, but still, um, you know, it would have been a lot better if I saw something like this before earnings, right? It's just like right to 43 and then a little bit of a recovery, uh, going towards 60 into earnings. Now we have this pattern here. And I said, like, well, if you guys waited for earnings to come out, okay, and then wait for it to pull back into the 80s, this would be a good time to buy, maybe. But with the way the S&P and the Nasdaq is right now, I'm not confident that that was a real solid bottom. Okay, like today should have been like this, and then on Monday it would just continue down a bit more, and then I would be more confident. But no, we're not. It doesn't look like we're having that. But we still have Monday. Maybe it still will go down. But this is the first day that we've seen the S&P move down 1%. We haven't had that in a long while. Let's see. So let me eliminate all this drawing. Now it looks so messy here. So here, zoom in here. So this daily, right? So this is down 0.99%. Let's see if we find any other 1%ers here. Any 1%ers? Nope. 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 Even this one. I mean, do I count this one? Because remember, it went down like this at the final few minutes of the day before popping up. I don't even know if I should count that as a real bottom move here. Like, was this really a bottom? Like, for a brief moment, it was down negative 2.44%. A brief moment. It's only a split second. Was this real? I don't know if I should count that. So let's say I ignore it. Let's go back here. Nope. Nope. Okay. So the only thing would be this gap here. That's it, I guess. I guess I would count that. That's negative 1.43. So that's a long while ago. This was June 23rd, nearly a month ago. And so we finally got a negative 1% day on the S&P 500. Okay. So what does that tell us here? Let's look at the VIX EQ. VIX of the single stock still high. Nothing's changed there. Look at the VIX. So the volatility of the S&P 500. It bounced today, all right, but not much higher than 20. Okay, barely touched 20 before coming back. Still not that shabby. Still pretty subdued. How about the dispersion? So DSPX divided by core 3M. What do we got here? Let's draw it as a line. Okay, we don't need log scale for this one. Okay, so we still haven't gotten back to this June level back in 2024. We're still elevated, but it did drop a lot today, down 10% from this index. So the bubble popped slightly. You see, I would have really liked it if this thing went all the way down here in the next 2 days. I don't know if that's going to happen now. Like today was pretty mild of a drop. Man, it's hard, huh? I think this market is really bizarre, very bizarre. And now you see it. Now you see it everywhere. It seems like certain stocks are highly volatile. The index is still calm for the most part. We still haven't gotten the point where people are really afraid. They're afraid in semiconductors, sure, but that's just because people are just gambling over there. That's why people are using a lot of leverage. It's being unwound right now, which is good. That'll make it a lot safer when we get to the big earnings. But I would be a lot more comfortable if I was for certain it was all cleared of the gamblers. All the gamblers are wiped out. But we might not be there yet. Maybe Monday will come around and we're gonna have some Iran stuff. Okay, so that's what I see right now. So let's look at HUT. HUT, I bought some today. That was a nice bottom here. It touched this 82 and it came back up. So that was a good. You see the gap fill? It's being filled right now. So it's just like when we were over here back in May. So that was a good time when I bought it. Was in this area between 95 and 84. I bought HUT G at that time. So I bought HUT again here. Do I want to buy HUT G? I haven't decided yet. I would have liked it if we had a bigger drop today. And what's the other one? NBIS, because this one is in the NASDAQ 100. So sure, why not? Give it a shot, right? Give it a shot over here. I'll buy it. I'll start buying here. So we had a good bottom today. Very nice. Okay. I think maybe if it got to 140, it would have been better, but that's fine. That's fine. And did we see anything in the software side? Palantir. No, nothing. Okay, it's still in that range. No, nothing, nothing changed here. How about MSTR? How about Bitcoin, right? MSTR Bitcoin. Nothing really. Very calm. It's just going sideways. So nothing there to get into. Okay, so if you didn't get in on the earlier dip, like over 2 weeks ago or so, 3 weeks now, no, don't, nothing to say. Nothing changed. I wouldn't be adding here. I need more proof. And what else? Oracle. Oracle, another software hyperscaler. This one didn't make much of a drop today, right? But I did hear that Michael Burry has covered his short. So he covered his Oracle short. He stopped shorting Oracle now. And that is a good place to just say, well, I made enough money because we're at the bottom of the range. If you're greedy, the next range for Oracle to drop to would be 102, right? That's still in play, though. Oracle doesn't report earnings until way later. So if all the earnings in the next couple weeks are all bad, oh boy, it wouldn't be that hard for Oracle to go to that level and lower, all right, before it reports earnings. But if you're not greedy, then yeah, that would be correct. Like if you shorted at any point above 190, sure, that's great. That's good enough profit for you. Why would you want to do anything else? Okay, let's look at Rocket Lab. Rocket Lab. ASTS recovered. That's good. That's good. Looks like ASTS recovered. See, so I drew this dashed line here because that was like around the tops and bottoms of these two. If it did this and went up, yeah, I would have been tempted to getting it at 55, but it's still 65 and plus, so I couldn't. Okay, I couldn't. So no, nothing there. I'm not biting any of the space stocks right now. I'm not doing that. Yeah, ASTS recovered. So yeah, man, we got till August 18th for the next earnings, maybe 17th, 18th. Yeah, this thing could still go to 37. I don't know. I would probably buy it there. So that's all I gotta say. Yesterday we covered like Chinese stocks. So if you want Chinese stocks, go cover over there. The stocks on the bottom are refinery stocks. Okay, so we talked about PAR, PARR, and PBF Energy. So this is the end, I believe. So for me, this is the end of the trade over here. I didn't play this. I'm just saying, like, if anybody was long towards the end of last quarter and it's wild either side, yeah, we just tried to make a range down here at this area, okay? So this zone, somewhere around like 66. So wait for a pullback. So a lot of these stocks like PARR, Par Pacific Holdings, and PBF, we're done. I think this is done. This is the final. We got Friday here. And one thing I want to mention is I noticed. So I was looking at the dark pool. Okay, I was looking at the dark pool, and I was looking at the volume today on the Invesco diversified commodity strategy. So this ETF tracks the commodity index. It has a mixture of, let me see if I got a picture of the composition of this ETF. Let me see. I think I did. I think I screenshotted this. Did I? Guess I didn't. Yeah, I guess I didn't. Oh, well, okay. Let me try to get it for you now. Hold on. Let me see if I did. Okay, still have it opened here on the window. Okay, this is good. Okay, let me see. Damn, the AI already answered it differently. Oh my god, so annoying. Damn. Man, when I ask the AI the same question, it gives me a different answer. Bro. Oh, okay, let me be more specific. Oh my god, come on. Give me the same answer you gave me before. Okay. Well, this is close enough to the same answer. All right. Here. So, you see the volume spike today? That was a lot of volume. Also, in the dark pool, there was a lot of volume. Somebody was exchanging a lot of shares out there on this particular product. The PDBC has also no K1 tax form. So, it's a lot more popular than the DBC ETF. So, there's a DBC ETF. It's pretty much the same as the PDBC, except that it doesn't give you that annoying K1 tax form that you have to use to file your taxes, and you're going to be like, oh, I can't just put this in my TurboTax. Well, okay, so people find this thing popular to use to get exposure to commodities. And I'm kind of wondering if there's a bunch of people that use this to trade oil indirectly in a way, because there's a lot of volume associated with this ETF. So and it doesn't have that K1 annoying tax form. Maybe people just use it instead of using futures or whatever, because some accounts, people can't use futures, people can't use options, then and they don't want to use that stupid K1 form what to file their taxes, then this ETF is really convenient. And the vast majority of this ETF follows energy commodities like crude oil, like gasoline, like diesel. But they also have other things like gold, silver, platinum, palladium, right? Which maybe they don't want. But because this thing doesn't give you that nasty K1, they rather just be lazy and use this. So that's kind of my feeling. And if you look at that volume spike, it was like 63 million shares traded just today. Okay, so I'm going to show you the composition of this ETF. Okay, and I have a feeling this is just some way for people just to get oil. So if people really thought oil was moving up this week and last week, then they might be done with the trade. Okay, they might be done with the trade. And let's see here. So the DBIQ Optimum Yield Diversified Commodity Index Excess Return. So this long name is the index that PDBA ETF tracks. So it's composed of liquid futures contracts. So this thing has all the futures built into the ETF. So you don't need to like learn futures or have access to the futures market. If you're lazy or if your account is restricted because you have retirement accounts and you can buy some ETFs, and the ETFs that you can buy, one of them is PDBA. You're probably just going to buy PDBA, right? Or something like that. Who knows? No clue why people would use this ETF, but there are probably a lot of reasons why someone would. The index utilizes an optimum yield roll strategy designed to mitigate contango losses and maintain exposure across the futures curve. So that's how the index is designed. And the ETF is replicating that feature. Okay. It is rebalanced annually in November to align with global liquidity and production data, which can cause target weights to fluctuate intra-year due to price changes. The index uses explicit weight caps to limit concentration. Representative allocations are outlined below. So this is what they try to set as the weights of each of these commodities in this index. So energy makes up 33% of the total capitalization. 16% goes to crude oil, Brent. 14% goes to WTI, crude oil. So 2 crude oil commodities right there. One from England, one from the United States. All right. The England one, the Brent crude, is the one that people use to quote prices internationally. The US one is only specific for us in the US. And then we have heating oil, which is basically diesel. They also put in some, gasoline. I see that they have some gasoline in there and other stuff, but mostly it's these three. Now, and maybe jet fuel too. I don't know. Precious metals, approximately 15%. So we have 15% gold, it targeted 1% silver. Then we have the industrial metals. Aluminum is 13%. Zinc is 2%. Copper is 2%. And then we have this agricultural mix right here. 8% goes to corn, 8% soybeans, 6% sugar, 4% wheat, 1% coffee, 1% natural gas. But for the most part, it just tracks oil, crude oil. So my thinking is, why the heck was all that volume happening today? What was going on there? And I suspect somebody knows something before the weekend. Either there were just a bunch of people that wanted to get in to buy, and some guy was thinking like, oh man, I'm getting out. I think this is good enough. I think this is a good enough time to get out of of my crude oil longs here using the proxy PDBA. If that's the case, then maybe Monday will be very green. Okay, maybe today was the dip. All right. On the other hand, maybe this is just a bunch of people that want to get out and take profits on a Friday, and someone came in and said like, I want to buy all your PDBAs that you can give me, and then all of a sudden this whole bunch of people came in, the dark pools everywhere, trying to gobble up any type of PDBA position for the weekend. Maybe there's going to be a big old war that's going to heat up over um over the next 2 days. I don't know, right? I don't know. If you look at the volume down here, like the last time we had a pretty significant amount of volume was June 30th and July 1st. This was before the PDBA ETF started improving, and most of that is probably due to oil. Okay, so here, let me put the Brent on this one. I think Brent. I can put Brent oil on this one. Here's Brent. Yeah, that's when oil started rolling back up. So somebody was buying over here. This is a lot more volume, so this really has me wondering what's up, right? The last time we had such significant volume was over here in April 8th. Um, and that was when we had the taco trade. So that was the final end of the actual oil move, okay? Because oil did go back up a little bit to the previous tops, but that was the final end of it. That was the last major first set of tops back in April, and people just took their money and ran off to semiconductors. So that's what this volume is. The good thing about the PDBA is because like they track other type of commodities, wheat, corn, soybeans, and gold, and this ETF still went up even though oil was starting to go sideways towards down, and eventually oil took over and became dominant again as it fell from like late March. That was over. This whole move here was mainly because of oil. So that was the last time we had big volume, during the taco in April. And now we have a lot of volume here on a Friday. Huh. Well, I hope this means there's something big coming out, and Monday I can finally get a dip. Or if we start moving up, then we have no choice but to chase it. So if we actually rally on Monday, so Sunday night going into Monday, uh man, I have a hard choice to make. I don't want to really chase things, but because of the way that you see how the S&P 500 is moving compared to the individual stocks, I think you kind of have no choice right now. So this is the momentum factor ETF here, MTUM. Now the reason I bring this up will be clear when I show you the charts. But look at the way this thing is constructed. This ETF, they try to stuff it with the top momentum stocks, okay? And momentum means what you think it means. If the stock is moving up very rapidly, they'll start increasing the size of their portfolio with that particular stock. So, guess who's number 1? Micron. Guess who's number 2? AMD. Guess who's number 3? Broadcom, AVGO. Guess who's number 4? Intel, INTC. And guess who's number 5? Caterpillar. So, the first 4 are already semiconductor stocks you know about. The 5th one is something I talked about, Caterpillar. Okay, this was in the boomer portfolio right at the beginning of the year. I said, like, I love Caterpillar. Caterpillar is a great stock, and it started rallying after its earnings again. So it's been kind of a hard thing to chase. Caterpillar doesn't give you like a dip that you think is worth getting into. It just goes sideways, dips a little, and then moves up again, and then does the same thing over. And Michael Burry wanted to short that. The sixth one is another semiconductor. We're back to semiconductors. Applied Materials, AMAT. Seventh, LRCX, Lam Research, another semiconductors. And then eighth, we finally get to an oil gas company, ExxonMobil, XOM. But for the most part, it's semiconductors, right? So 6 out of the 8 are semiconductors right now so far. And then the next 2 to round out the 10 is Johnson Johnson at 9, ninth place, J&J, and 10th place is GE Vernova, another industrial stock that I love. So in the boomer portfolio, the GEV and the CAT, Caterpillar. So we got 2 industrials, 1 gas and oil, and 1 pharmaceutical, J&J, medical devices or whatever you want to say. J&J, J&J is kind of like consumer staples too. Baby oil, right? Baby oil is consumer staples. So J&J is kind of like has a broad exposure to a lot of sectors, I suppose. But mainly, people probably would think it's just a healthcare company. But over half of it is semiconductors. So that's where we're at. Now, if you look down here, what we have here, Google, Walmart, Cisco Systems, Seagate, Western Digital, 2 more memory stocks, Google again. So Google, Google class A stocks and then Google class C stocks have, wow, okay, so they put it in twice. Great. Don't know why they did that. Texas Instruments, Clack, Chevron, okay, Corning. Okay, to round out 20. So out of the 20, which one of these? So the second 10 here, we got 2 Googles. All right, so that's tech, but I don't see anybody else. Where's Amazon? Amazon ain't here, so sorry, buddy. Amazon, you didn't make it because you weren't you didn't have high momentum. You didn't go up fast enough for it. Walmart, I guess, counts. Interesting. Seagate and Western Digital makes sense. That's memory. One of them is a hard disk drive. The other one is SSD drives. Okay, so solid state drives. But yeah, for the most part, it's still like memory. So they kind of related to the semiconductors. All right. So even though solid state drive, solid state drive is still memory, but whatever. Hard disk drive is not semiconductor, but might as well count that. Okay. So for the it's just semiconductors and semiconductor related. So that's where we're at. That's where the momentum trade is right now. All right. So let me get the graphs for you. Okay. So let me get this for you. So let me show you here. Momentum, right? Look at this. Exhibit A. Exhibit A. 3-week realized volatility of the momentum factor divided by 3-week realized volatility of the S&P 500. So the realized volatility of high momentum stocks, like the stocks in that ETF, is 4 times more than the volatility of the S&P 500. And this is at an all-time high. Look at the last time we were this high, during the COVID era. And then before COVID was during like 2018 and 2019 over here. Okay. So most of it happened in your right hand side. So past 2014. Now, if we go to 2008, even during the great financial crisis, it never went above 1. Okay, so during that time, really, it's only went as high as 1.5x around 2007. So during the height of the great financial crisis, when the market was tumbling, and then before that was the .com, and that barely got to 2. We're at 4. So these stocks like AMD, Micron, SanDisk, they can go upwards to 4 times the volatility of the S&P 500. So this is a record. We're at a weird time, my friends. Weird time. Oh, yeah. I don't know. I don't know what this means. I mean, we already see the stuff with Korea. So I read a lot of stuff about Korea yesterday, right? So look at this. Look at this. 1.2 million retail traders received margin calls this week. That's what I was saying yesterday night, which is 3.4% of South Korea's entire adult population. South Korea's leverage bull market unravels, all right? So we got this 1.2 million retail investors, right, getting the margin calls. The rate surges from 2.1% to 10%. Okay. As of July 13th, more than, okay, whatever, blah, 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 same thing. So this is equivalent to 1 in every 30 adults facing potential forced liquidation. So this is where the 1 out of 30 came from. So I was looking for some article that was talking about it, but there wasn't any article that was free that was saying that. So I guess this was like a note from Goldman Sachs. The forced liquidation rate has surged from an average of 2.1% to 10%. That's what it says here. So I don't know what's below this screenshot, if there's any more information, but there you go. Maybe this this whole leverage ETFs and stuff, this is what's causing what we're seeing here, right? Because there are a lot of leverage ETFs right now, and I'm going to talk about a few of them that came out for SK Hynix. So if you want to gamble, yeah, there's a lot of options for you. A lot of options for you now. Okay, that was it about. Okay. Something else I want to talk about. Not this, not yet. Ah, here it is. Okay, read this thing. Read this tweet. So the Morgan Stanley TMT desk putting the momentum unwind into perspective. I don't know what TMT means. Whatever. Just 17 trading days into the unwind, TMT momentum is already down negative 40%. So the Goldman Sachs also came out with something similar. Maybe I have that tweet somewhere here. Let me see if I can find it. See if I can find it. Okay, maybe it's this one. All right, I have this one queued up. Okay. So down 40%, making this both the fastest and deepest sell-off at this stage on record. The previous worst in early 2021 was down negative 29% after 17 days. So after 17 trading days, we are down 40% on these type of momentum stocks as listed here, right? There we are. And if you look at the weight, 18.43% is in technologies, 13.65 in communication services. So combined, technology and consumer communication services make up about 30%, right? Yeah, 30%. That's about 30%. I'm surprised financials make 18, but I guess the banks have been moving up very nicely, so they've been putting a lot of allocation there. But for the most part, the best ones are concentrated in semiconductors like Micron. Okay, let's get back here. So across downs of more than 10%, only 2 have been deeper. The dot-com unwind of 2000 2001 remained the benchmark, with a decline more than 50%. While November 9th, 2020 still stands as the worst single-day momentum reversal when Pfizer vaccine was announced, abruptly flipping the market leadership. So once the Pfizer vaccine was made after elections. Remember, they had that announcement ready to go, but they waited until after elections before they released it. And that's when you had like the Biden pump. So after Biden got elected, after the Pfizer announcement, you had this final rally from November into February of 2021. And that was where all the final meme stocks, the little crypto shit coins, those things went up at the same time. So that's what they said by flipping it. So first, people were hiding out in certain sectors of the stock market, but once the coast was clear, they started moving out and going to like meme stocks, small caps. Yeah, small caps did the best, and especially the biotechs, right? A lot of small cap biotech started moving up very rapidly from that time. So that's what they were saying, like the leadership was changing. So so that was flipped out. Matt Garman describes a sleuth of bear markets. I don't know, did they really mean sleuth or did it mean slew? Okay, that's weird. Why would you use the word that way? Is that the right way to use that word? Is there a second, third, fourth definition of sleuth? Kospi, the Korean markets, was down 27% from the peak. Global memory, so I guess that's SK Hynix, Japanese Konixia, and Micron, SanDisk. So everything around the world that does memory down 36%. US AI tech beneficiaries down 24%. US momentum down 28%. And US tech momentum down 40%. Okay. So I like this guy's tweet over here as a response to it. Fastest and deepest is the tell that this is positioning, not fundamentals. A negative 40% in 17 days doesn't happen because earnings have changed. It happens because everyone was in the same crowded factor and the exit is one door. Speed like this is deleveraging, and deleveraging ends when the leverage is gone, not when it's cheap. Okay, so I really like that comment there. I think this is kind of like a preview of what you're seeing happening in Korea, right? We're just echoing what's happening in Korea. So Korea is having its issues, and we are just manifesting a part of that in our own markets with the semiconductors. So SK Hynix, Samsung is getting beat up along with other tech names in Korea, and so our tech names are also getting beat up, but it's not affecting the rest of the S&P 500. That's what's happening because everybody was over leveraging in those stocks. That's all. That's all that means. Okay, because they were just using options or they were using margins, like overloaded with this. Their positioning was bad because they had way too many shares of Micron or way too many option contracts of Micron, or they were just loaded up to the gills with 2x leverage. Oh man, let me show you this. Oh yeah. Hold up. Let me show you this. Yeah, let me see if there's an archive of this one. Damn, I don't know if they did. Let's see. No, they didn't. Damn. Oh well. There was no. I don't know. I don't know what the original comment was here, but here I'll give you this. This is from the Reddit thread from SanDisk. I think you can probably infer what they were saying in this original post, but I don't know. I don't know what. I don't remember what exactly they said. But if you go down here, if it drops another 10%, I'm blocking Reddit and I'm deleting the brokerage account and Yahoo Finance. I'll check back in no less than 3 months. That's it. No, you will not. Yeah, you're right. So, man, I cannot stand another fall, honestly. Bro, if I have a crystal ball, I'd make millions shorting it, but nobody knows about tomorrow. So this was like 2 days ago. Like SanDisk was dropping like a rock, right? Micron was dropping like a rock. All these guys were just like going crazy. They're buying this leverage ETF SNXX, to get into SanDisk. Guys, I have an SNXX with an average price of 23.5. My gut says hold, and it will be green after a roller coaster ride. Oh my God, you're crazy, dude. This is leverage. But that would have made sense if I was holding SNDK. Well, SNDK recovery mean recovery for SNXX given that it decays. No. Oh man, look at the example of XBI. Okay. Even if there was no decay, like you have to understand, this thing tracks each daily move. If it starts moving down rapidly, you know, you would have to assume SanDisk would go up. So if you go down 50%, right, on your leverage, like SanDisk goes down about 25% in several days all at once. And then you're about like SNXX would be at least 50%. Sometimes it'll go a lot more. Like if you short MSTR, right? When I shorted MSTR, the leverage ETF gave me extra than what it would have given if it was just like zigzag. If it went down a straight line, yeah, it would go down more than just 2x 25%. Okay. So but let's just say it goes down 50%. That means for you to be made whole, SanDisk would have to go up what 50% for it to go 100% so that you would be made whole. Because if you bought SNXX at $2 and it became $1, okay, you have to make another dollar for you to be made whole again. So that means SanDisk has to go up 50% now to make back what you lost going down. So that's why you do not want to do leverage when the trend is no longer your friend. So if there's no trend, don't be buying leverage. Okay, get out. Um, if the trend is starting to break, if you notice anything that looks bad, you have to set your stop. You have to get out. You're going like, whoopsie, I'm not gonna stay here no more. My bad. So yeah, this is not good. You're gonna have a lot of people that will start acting like this. Like like this is just basic mathematics, man. I bought 9 SanDisk stocks close to at the high because I want a short trade of 5 to 10%. Luckily, I don't need the money in 4 to 5 years. Oh my. See, this is the mentality you get. Now I learned this kind of gamble can backshot and change your plans a lot. Also, I learned the value of not gamble. Not to gamble, you mean, with leverage ETFs or using money that I would need to use in the short. Okay. See, this is the psychology that will make this market crash one day, right? We're fortunate so far that it's being contained in just a few stocks, in these momentum stocks. But that might not be true later. So take this as a warning. Study the oil trade that we did a few months ago, right? A lot of people were like really bullish in oil. They really thought the war was going to accelerate. Trump was going to really try to bomb Iran some more, maybe send ground troops, whatever. Never happened, and we roll back. So if people were leverage oil over there, they got killed. Same thing with the memory stuff. Same thing with all this. Like, if you got to be careful. You got to not fall into the trap of thinking like it will just keep going up all the time. There's going to be an end point. There'll be another time for you to get in. Don't take your profit, move on. Okay, so here I was thinking we'd be over 1,000. This is the Micron guys here at the Reddit on an uptrend based on yesterday, and here we are. Seems like this was a lose-lose situation driven by ASML earnings. If they missed, we go down, and if they beat expectations, well, here we are. Seems like money is flowing back into the Mag 7, so that means Google, Meta, like the original Mag 7 stocks, right? Apple ahead of earnings, but maybe that'll be the next catalyst for the leg up. Definitely need a strong stomach for these stocks, and helps if you had a low entry point. So let's see what the people comment here. Uh, any interesting comments? Oh, rotation out of memory into hyperscalers. Google, Meta, Amazon, Apple, Oracle, Microsoft are all up 3 to 4% today. That's a large shift in capital, likely in preparation for earnings over the next few weeks. We'll have plenty of solid understanding of AI spending sentiments. Okay, nothing there. Um, is this cope? Is this cope? But how does that make sense? That SanDisk and Micron and others are losing 10%, but the Mag 7 is only gaining 3%. That's like nothing in comparison. You're comparing a SanDisk worth 220 billion and Micron worth 1 trillion to companies worth 2 to 4.5 trillion. Completely different playing fields, my man. Yeah, there's a lot of newbies, right? Like you can't compare price together. There's market cap. That's one thing that this guy is failing to understand. Oh man, there's a lot of novices here. A lot of novices, newbies. Oh my god. Yeah, I don't know. This is just whatever. This people are just blaming everything. Okay, nothing interesting there. Just a bunch of like morons. Okay, what other stuff? I was going to talk about something else. I thought maybe we had some stuff about the Korean side. Let me see. Blah blah blah. Korean interest rate. Okay, so I have this article here. I'm going to read this one. Anything else? Associated Press. No, I'll just read this one. I'll just read this one. So the Bank of Korea hikes rates for the first time in 3.5 years, signals more. So this was like a couple days ago. So this thing was not helping matters, all right? As the bubble was popping, this thing definitely accelerated the bubble pop. Seoul, Korea, July 16th. South Korea's central bank raised its benchmark interest rate for the first time in 3.5 years on Thursday and flagged more to come as brisk growth in Asia's fourth largest economy fanned inflation risks. The 7-member Monetary Policy Board at the Bank of Korea voted to raise the 7-day repurchasing rate by 25 basis points to 2.75% to stabilize a slumping won and counter persistent inflationary pressure. In a statement, the bank also said the economic growth rate of South Korea is expected to considerably exceed the bank's May forecast of 2.6%, while inflation will remain high for a considerable time. With developments across all three areas, growth, inflation, and financial stability, supporting the need for an interest rate hike, it was judged appropriate to raise rates at this meeting. Governor Shin Hyun-song said in a news conference. Unlike major countries with weak economic recoveries, demand side inflationary pressures are expected to gradually increase as the impact of the semiconductor boom spills over into domestic demand. All right. So anything else? I think they were going to say they had plans to raise more. Gross domestic product expanded 1.8% in the first quarter, the fastest pace in nearly 6 years, prompting government to raise growth forecast to a 5-year high of 3% for this year on the back of global semiconductor boom. Shin was remarkably clear. Usually, when officials say they are data dependent, they speak in general terms. but he gave two specific indicators to watch: second quarter GDP and July inflation data. Said An Jae-kun, an analyst at Korea Investment Securities, who expects the BOK to raise rates again in the fourth quarter. By clarifying exactly what to monitor and signaling that the door remains open for back-to-back hikes, those comments help alleviate market uncertainty. The rate hike aligns the BOK closely with the central bank in neighboring Japan, which recently raised its own benchmark rate to a 31-year high. Central banks in Australia, New Zealand, Indonesia, and the Philippines have already tightened their monetary policies, with the headline inflation figure at a 2.5-year high in South Korea, thanks to the war in Iran, I guess, too. A majority of analysts see the Bank of Korea delivering at least one more rate hike before the end of this year to take the policy rate to 3. So, median forecast showed that BOK would raise its key rate to 3.25 in the first quarter of 2027. So what we have now is something that could stop permanently, maybe permanently. Maybe the Korean stock market right now is going to have trouble, a lot of trouble going up because of this. SK Hynix, however, has put their stock in the NASDAQ. They have another way of making money now. If the Koreans can't afford to buy their stock in Korea, we still can. I wonder if this is just a speed bump, and this will just help fuel the flames for our own bubble in the United States. Okay. And if Samsung also joins SK Hynix, and they denied the rumors, right, that we saw this week, they denied it. But, that doesn't mean anything. That might turn out to be true in the end of the day. If Samsung has plans to put themselves on the NASDAQ too, well, we could have a nice little bubble on our side of the ocean, and we take over from the Koreans, and we can take their money and go up. All right, here's an example chart here. I want to show you something. So the stock market looks ahead, okay? They look at the future. In 2002, during the time when internet was being used everywhere, like we were just in Web 1.0. But people were using the internet. We had a dot-com boom, right? It wasn't everybody using the internet, but there was an increasing number of people using the internet by the time the 90s ended. So by 1999 going to 2000, the trend was clear. More and more people were going to use the internet. We didn't know about the smartphones yet, right? Smartphones came 5 years later, about, right? 5 to 8 years later. But the newspaper, the actual physical newspaper itself, people already figured out, oh, that model is probably going to be a dead end. There will be a time when nobody will use printed paper newspapers to get their news. And so by the time we got to 2002 to 2003, you already see the stocks of those newspapers start dropping. And the trend was set then. It kept dropping all the way into 2009, which was the time when we had a lot of smartphone usage gain traction and social media. So the stocks themselves, the newspaper stocks themselves already showed you the future. Because if you look at the dark blue or turquoise, I guess you could say it's turquoise, this is the actual earnings of those newspaper companies. The earnings of those newspaper companies did not start really dropping into late 2007, early 2008. So it was 5 years ahead, right? The stock market was already 5 years ahead. So I'm always worried and always nervous when you see something like a Micron or a SanDisk and it goes up a lot like it did the past 6 to 9 months. Are we just pricing in what is going to happen in 5 years, right? 2 to 3 to 5 to 6 to 7, 8, 10 years ahead. And this is it. Like, unless people are very confident that you can keep growing past 2030 at the same rate you have, because all we have is about like projections into 2027, 2028, maybe. We have an idealized model that says, like, oh, AI is going to grow at this function. And so memory demand will grow at this function and it won't stop until maybe sometime in 2029. But that might not be true, right? That might not be true. But let's say it is true. Is the price that we're seeing right now the end of it? Like, this is the price you should expect. Maybe not much more. Maybe Micron will go up 2x and that'll be it. That'll be the final hurrah. So that's something you got to keep in the back of your mind. And if you go back to the Mark Muldrum, the Canadian dude's presentations, he goes over like kind of like how he feels Micron is. I still have to go back to that video to finish up some AI conversations about the cost of AI, but I'll have to do that some other time. Sorry, guys, I can't do it. And I also have the sunspot stuff. We haven't got to yet, the sunspot stuff. So tomorrow I got to do I'll have to do 2 presentations, at least probably 2 hours each. So I'm gonna have to do one in the morning, one in the afternoon. So I'm trying to get a date where I can just do 2 back to back in the same day that's like about 2 hours, because there's a lot to go through in that case. Okay, we already covered this. That's good. Okay, this is another one I wanted to cover. This one's interesting. This is exactly what I was thinking today when we had that dip. I was thinking, like, what are the CTAs doing? So CTAs are commodity traded advisors. These guys go with the trend. All right. So when stocks are moving up, they'll follow. If stocks start moving down, they'll position for it to go down. So they're always trend following. These guys are major trend followers. Now, let's look at this chart in detail. Okay, let's look at this one. So maybe I just open on a separate bar so we can zoom in. Zoom in. Okay. So look at the whole picture. Okay, we got the date at the bottom here on the x-axis, and with the S&P on the left-hand side. The S&P is the white line moving up, and the CTA positioning, Q CTA positioning. So negative position to positive position, that means we're going long or short. Okay, so if you look down here, we have a legends here. Positive regime, the green side of things, the CTA positioning is net long, typically supportive for risk assets. Neutral is kind of like that yellow part here between 0 and 0.1. CTA positioning is balanced, less directional impact, so it's neutral. Negative regime CTA positioning is net short, typically a headwind for risk assets. So risk assets, you can think of the stuff in that momentum ETF we just covered. That's one kind of risk asset, I suppose. The another one would be like the small caps, especially the ones in growth, right? Small cap growth, like the biotechs, like Moderna. Okay. Well, Moderna is no longer really small cap. It's really a mid cap, soon to be large cap, but I still think of it as a small cap. It kind of has that small cap feel. Okay, another one is divergences matter. So down here it says divergences matter when CTA positioning. Okay, let me zoom in. It's like the font here is so bad. When CTA positioning diverges from price, watch for inflection. Trend is key. Rising CTA means increasing risk appetite. Falling CTA means de-risking. So the green line going up and down, not the white one. The white one is the S&P 500. So let's look at July 2024. So this was when the yen carry trade happened, right? So that's why it was dropping here. Um, the S&P didn't really feel anything. This thing only affected certain risk on stocks like Nvidia, like semiconductors. That was in July of 2024 to August of 2024. So you see this thing was from green going into neutral. That's what happened there. And then we started going back to the green. So they were like, okay, well, this thing says we're going to have good times, right? We're going to have good times. And now look at this. Look at this. Look at this. It started dropping even though the S&P 500 was going sideways. So where was it going sideways? It was going sideways from late November, December, January into February. And then what happened here? Why did the S&P 500 started going down? Because of the Trump tariffs. But the CTA positioning already was getting kind of like confused here, you see? By the time we got to January, it started going down a lot more and it made a lower high. So it was diverging. It was diverging. So it made a lower high while the S&P made like a minor high, or you could say the S&P went flat. They made the same high in January to February and December. And that was before everything started going down because of the tariffs. Now, look at here. Look at here. This was around September, October of 2025. Look at this top here. The same thing is happening. We made a top, but the next high we started moving down was around probably November here. And then we made a lower high December going into January 2026. So we made a high here, a lower high, and another lower high going from September down to January of 2026. And that was before the whole Iran war started kicking off. Okay. And you can see, like, even here, it was already dropping, like, into March. So by the time we got to March, it was already it's well on the way down to its low level. And we hit a bottom here at an extreme red level at the end of March going into April. And that was the bottom. So where are we now? Where are we at now with the CTAs? This is June 26th. June 26th. That's the last data point we have here. So we're getting into earnings, right? We're going to earnings. This was the end of the quarter. The CTA is still rebuilding its exposure ahead of new highs. So it's still going upwards. We're still on an upwards trajectory here. So that's good. We haven't seen something like this where we make a nice new top and then we're going down. So we're still cautiously optimistic on the CTA. Okay, so hopefully you understand this graph. Now, I'm going to go back to the tweet now. Time to go back to the tweet. This chart comprises the S&P 500, the white line, with CTA positioning in the green line. That's what I told you guys to look at over the past 2 years. The CTA's commodity trading advisors are systematic funds that often buy when trends strengthen and reduce exposures when trends weaken. Okay, so let me zoom in on this. I don't think you need to see the graph anymore. Understanding their positioning can help explain shifts in market momentum. Right now, CTA positioning is currently constructive and rising. Trend following funds are generally net long equities, but positioning is not at extreme levels and could still flip if the market weakens. Notice what happened around the major swings. Early 2025, the CTA positioning turned negative as the S&P corrected. Mid 2025 positioning recovered alongside the rally. Early 2026, another sharp drop in CTA exposure during the market pullback. Today, positioning has climbed back into positive territory as the S&P 500 reached new highs. The trend in positioning has broadly followed the trend in price. So that summarizes what I said as we went into detail in that graph. Okay, so for beginners, CTA positioning isn't a prediction of where the market will go next. Instead, it shows how trend following funds are currently positioned based on their models. Think of it as a sentiment and positioning indicator rather than a forecasting tool. But you can see here that you can use it, like it can work. If you like, these divergences are pretty clear. You can see a lot of these divergences here. So it can sort of predict it. You just can't tell when the top will come in, right? This top here was made in 2025 around September, October. And the actual drop in the S&P 500 only happened until the Iran war started in March of 2026, many months later, right? Now, if you look this one in 2024, let's say the top was made in December of 2024, then the actual top was made sometime in January, February of 2026. That was just a month away or 2 months away, but still, you didn't know when the top was actually going to come, right? So it has some minor predictive elements to it. So I don't know. I would kind of disagree with this in a way. So why does this matter? When CTAs increase long exposure, they may add buying pressure if the trend continues. When they reduce longs or flip short, those flows can add selling pressure during weaker markets. So right now we're okay. I don't think we're in a weak market. So that's why I'm pretty confident when I say, like, you look at Intel, right? You look at something like Intel and HUT, you've been going sideways, right? They're not as weak as a Qualcomm or an ARM, right? Looking at those stocks. So actually, let me just show you the charts just to remind you. So when I look at something that's going in a range that's um, fairly horizontal, okay, something that's fairly horizontal. So something like HUT, right? Let's go to HUT. NBIS is kind of not that. NBIS is a little bit more aggressive. But for the most part, if you look at HUT and you look at it from a long-term perspective, like look at the weekly chart, right? You look at something in the weekly chart, it's still above the moving average. All right. If something you look at like something like NBIS, it's penetrated the moving average. Also, it went well above the range here before having this candle, this next weekly candle, reverse everything it did on the previous breakout. So that's bad, right? So this is kind of wilder. CIFR, same thing. You see the wildness. It's broken. It tried to break out of this resistance. It failed. It also went right through back into the range, and now it's below the range. So this has a wider expanse. But if you look at something like HUT, it's a little bit better, right? Physiognomy wise. We broke out of the resistance here at 85. This resistance was set back in 2021. It's still above that. The range is above that. Um, the actual like size of these corresponding red candles is smaller than the one at NBIS. The only really big red candle is over here, which is negative 21% back in June. So this was like June 29th, so the end of June. So outside of that, it looks relatively better. So if I see something like this, I'm going to take a shot, right? I'm going to take a shot because the conditions of the market is still green. The CTAs agree with me. They are green. Okay, so that's quick. Now that's all I want to say. But so then you look at something like Intel, same thing, right? Intel or Texas Instruments, like you have like this nice range that you're following here. So I'm more willing to buy the dip here and go like, hey, so you're touching the moving average. I'm gonna say that you're gonna recover. because the market conditions are still green. So I'm going to trust that this will this will continue the trend up. I haven't seen anything bad yet that would suggest otherwise. Texas Instruments, even better, an even better stock, where it has a tight range. Right, this is still above its moving average on the weekly. We're still in this sideways motion. Still good. Okay, it has a nasty candle. I got you, but we're still above this red line set by this green bar in earnings. So hey, I gotta take it. I gotta take it. I think Intel, you can say the same thing too. You have the earnings, you got the move up. Here, we're still above it, right? We're still above it. So this was earnings week. We're still well above it. So we're fine. I'm gonna stay positive and buy the dip here. If the market suddenly flipped, if we started doing a bearish move in the markets, the conditions start changing. The VIX starts moving up, so the S&P starts crashing, right? That's why I said look at the S&P. We went down on Friday today or yesterday now, for the East Coasters, 1%. Last time we had a 1% plus down drawdown on the S&P 500 was about a month ago. So still not, doesn't look like it's bearish yet. Okay, so that's all I wanted to mention. I think that's good. Yeah, that's all I wanted to mention there. Okay. All right, I'm going to take that away. Okay. Let's get back to this. All right, let's get back to the tweets. Let me repeat this paragraph. When CTAs increase long exposure, they may add buying pressure if the trend continues. So right now, we are green. The market conditions are green. The CTA is green. So if there is a resumption of the move, then it should be very easy for this to continue up. All right. We haven't gotten to the extreme levels yet in the CTAs. All right. So I don't know what the up to date CTA numbers are right now, but June 26 is kind of out of date. Do I have to pay money to get the up to date CTA? I guess I have to, huh? These guys want to sell me something. Like if I want the actual CTA positioning for this Friday, I need to pay, huh? So, but in any case, I'm assuming that it's not up here where we were in September 2025. I don't think we're there, right? So we have a lot of room to go up. So this could get very optimistic if we continue up, right? So that depends on earnings. So if earnings goes well, I'm thinking like, yeah, August will be a very good top. Will be a very good top in August to September before midterms. Once we get to September, like first week of September, second week of September, I think that's probably where the top will be if we make it through earnings. If we don't, if you looked at my S&P chart, you see it's going down, right? It's eventually going to go down in August. Either early August or mid-August. So that's when all the earnings are already out. That's it. That's all I got to say about that. Okay, so when they reduce longs or flip short, these flows can add selling pressure during weak markets. We're not there yet. Watching these shifts will help provide context for market moves. Conclusion, the chart suggests CTAs have rebuilt long exposures as the S&P 500 has recovered to new highs. It doesn't guarantee the trend continues, but it does show that systematic funds or systematic, systematic, is that a word even? Systematic, whatever. Funds are currently aligned with the broader uptrend. thread is for educational purposes only and is not financial advice. All right. Thank you very much. Yeah, I'm guessing I have to pay money for the up to date. You guys only gave me June 26th data. That's nearly a month old, bro. So, well, I'm not going to pay. I'm not going to pay for it. If you guys want to, go ahead. You know where to find them. All right. So one thing I was talking about yesterday was the China stocks, and I'm gonna end this stream with reading from Michael Burry. Michael Burry tweeted out his little article about China that he wrote like at the beginning of the year. He was like, "Oh, you should buy Chinese tech stocks. I like Chinese tech stocks," and he tweeted it again. So maybe he heard me. Maybe he heard me last night when I started saying, "Yo, you should buy Chinese stocks or Chinese tech stocks." I mean, in particular. So the other sector that looked good, that looked like it was recovering a lot, was U.S. Business Training and Employment Agency, essentially recruitment firms, all right, or consulting, employment consulting firms. So I made a tweet, and we can go over this graphic here. DHX. The reason I made this tweet was in response to this one. Millions of Americans want jobs but can't find them, and the number now exceeds the great financial crisis. So there's a lot of people looking for jobs. They're going to temp agencies or whatever, recruiters. They're trying to get a job. And so yesterday night I was thinking, why is this area recovering so well? Is it really hard to find a job now? And then this tweet came out and I said, "Oh, well, that answers it." So no wonder people are buying up these stocks. So we have one here that's made 164.52% year to date. DHI Corporation or Group Corporation or Incorporated. I don't know which one. DHX, that's the ticker. And then another one is Corn Ferry. This one is, so the DHX is a small cap. Corn Ferry is KFY. I think it does executive management consulting. And DHX is like AI recruitment. So kind of more like a little tech company in a way. And Corn Ferry is up 21.06%. And then I asked the AI to find me similar stocks uh, from those two. And they gave me these. There's a Japanese company called Recruit Holdings, but they do have a ticker in the OTC markets, RCRRF. And we have Upwork. We have Fiverr. I think you know Fiverr. That's where you hire the little Indians from India to do some grunt work. And you have Zip Recruiting. Okay, so we have these four. Maybe we'll look at them some other time. But take a screenshot of this tweet here that I made today, and then now we're gonna go look at this image. Okay, let's zoom in. So this is what the stock charts gave me when I was searching for sectors that looked good. So we had China yesterday, and today this list is another one that we can start paying attention to. So take a screenshot of it because I might start picking out some of these. So I picked out the KFY, we have the Corn Ferry, and I also picked out the DHX. So I have two companies. Now there's some of these that are losers, right? We have Coursera. I think that's just like a learning kind of online learning place, right? 24% down. I think that's what it is. We have two that are down 60%, but these are like small companies here. 61%, that's 765 million market cap. That's a mid cap, and we have one that's such a tiny one that might as well be considered a micro cap at 99 million market cap here. Here Group Limited. I don't know what that is. BG Staffing is up 23.97% small cap. So we have staffing services. Okay, so I'm gonna have to look through some of these. Some of these look good. We have Manpower Group. 80%. I was looking at that a little bit, so I said, "Oh, okay. Well, that one might be interesting." So, anybody else? I don't know. I don't know what the heck. kforce.com. Anybody use that? I don't know. So, yeah, take a screenshot. That's what we're going to be discovering next week, I think. So, that's another sector we'll look at. So, continuing on from China tech, we're going to go into recruitment services because I think AI is going to wipe out a lot of jobs. I guess people are going to get desperate and they're going to use these services. Oh, let me get rid of the scrolling banner here. Okay, so all right, so take your screenshot. There you are. MACD looks like it's done on Intel Weekly. Yeah, but you're already so high. No, no, it's gonna because yeah, I've seen pinches before. That's why if you just use the indicator, it won't tell you like if it's gonna do that or that when it's like that. It's the on that higher time frame, you're just like you just don't know what it's gonna do. Yeah, that's why if you rely on just the indicators, nah, that's not enough. Yeah, that's not enough. That's when indicators will fail you. I've seen a lot of times where it will just reverse the next week, and next week we have like earnings too, right? Earnings will be enough to change it, depending on earnings. Well, I don't know what earnings is. Do I have a crystal ball on earnings? No. Does technical indicators predict the reaction to the earnings or what the earnings will be? Nope. So that's when indicators don't work. That's when technical analysis doesn't work. Right? You got to wait for the news, and we know when the news is coming. It's coming down in a few days, so yeah, just 5 more days, and you'll know what will happen. So yeah, that's why I said technical indicators, technical analysis. It's not a crystal ball. It's never going to be really truly a crystal ball for you. So uh, unless you got some kind of insider stuff. If you got some flow information, yeah, maybe that'll help you a little bit better, but we don't have those things. We just don't have those things. Okay, something else. Nope. Nothing. See here. Anything I want to talk about? Air. Okay, air was like around 80. I'll talk about more about that on Monday. We can talk more about air. And I talked about the uh, space stock. Good. Okay. Let me see what other graphics I wanted to show here. I had some other graphic screenshots of things. Let's see. Covered that, covered that, covered that, covered that, covered that, covered that. Before I start reading the Michael Burry stuff a little bit. I won't go too long. I'll just read a little bit of it just to whet your appetite. Yeah, I guess I didn't screenshot anything else over there. Nope, I guess we're done. All right. So then the rest will just be tweets, a few more tweets that I wanted to cover. Let's see. Done, 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 done. Okay. Yeah, we're done with that. All right. Let's see. See if this was it. Okay. Hmm. Hmm. Okay, so we have this one from Silver. I might talk about this some other time. I don't think I want to talk about this right now. But the ETF for Silver, there was a ton of outflows so far. Negative 50% drop. So I'm trying to see if there's a bottom on silver and gold anytime soon. We could be getting close. We could be getting close. This will be a sign of reflexivity, you know? Like you see during COVID, everybody was rolling right into silver ETFs. And usually the silver ETFs is retail, man. It's retail. It's always just retail traders. They just want to run in there and get in. So that's something we got to watch for. So that one, yeah, that one. Yeah, I think maybe we gotta look at, but yeah, really wasn't it. I don't think I wanted to talk about that right now. Let's see what this one was. This tweet here. What did I tweet about here? No, that's the same thing. Okay, did I have something else? I don't know. I thought I was thinking I was gonna talk about something else, but maybe we really just covered everything already. Guess we're done. Yeah. Let me see. Container shipping. No, I don't want to care about that. Already finished that. Okay, process. Nope, nope, nope. No, I didn't ever want to talk about that. Chinese AI. I'm gonna talk about Chinese AI some other time. Don't really care. This one, the Morgan Stanley stuff continued. Don't need that. This one's pretty close to what I was talking about. All right, so this will be the last thing I'll talk about. I don't know, maybe this is it. I think we've already covered a lot with the momentum stuff. So, the high beta to low volatility relative basis. So this is a ratio, okay, between the S&P 500 high beta to low volatility ETFs. So last three drawdowns was negative 17%, July to August of 2024. So that's the yen carry trade unwind. Negative 29%, Trump tariff trade tantrum. And then 11% was the tech to value rotation and the Iran war 1.0. So we're already 2 days, 3 days into the Iran war 1.5. Okay, the next 60-day war. We're already in it right now. So that will last until September, right? Okay. So that's what I said here in the tweet, and you see here in the graphic. So let's zoom in to the graphic that I made. And you see the DeMarc stuff here all mapped out for you. So this is another reason why I think it's probably about to be over. I don't think we're going to be as bad as the trade tariffs unless the next set of earnings in the next 2 weeks are so bad that all the tech companies will start dropping altogether. Right now, it's just the semiconductors are like taking away the froth, right? And some of the AI and some of the related equipment manufacturers, the computing hardware manufacturers. So those guys are kind of like going down too. But we're seeing some recovery. I think Oracle probably is at the bottom, so that should recover. Some of the software and data center hyperscalers like Microsoft. So Microsoft will report earnings in a week or 2 weeks. I don't know. I don't know if it was this week. I don't think so. Let me check the schedule here. Yeah, I gotta check the schedule. I forgot about doing that. Hold up. Okay, e-whispers. Okay, let's go to e-whispers. Yeah, I don't see Microsoft next week, which is weird. Usually Yeah, usually Microsoft will be one of the first ones to report earnings in tech season. Looks like Google will be the first one. Then it'll be like there'll be another. Okay, well that's weird, huh? Huh. Well, Microsoft doesn't want to tell us what's going on. All right, we have to wait. Like fucking. Google will report first. Oh, all right, fine then. Well, hopefully that'll be enough. I hate it when I have to wait until the final week of the month we get everything. I'd rather they just split it up better. So we only have Google to report, and then after that, Intel. That's it, huh? Nice. Well, that is annoying. That's really annoying. Okay, here you go, guys. I'm gonna put the image up. Okay, you see that? What do you see? Well, I have Steel Dynamics on Monday. I got Domino's Pizza on Monday. Well, Steel Dynamics, yeah, I'm curious to see what that is. STLD, that's the ticker symbol. That's gonna be important for steel. That will be the first steel company we have. We already had Alcoa report, so I don't think Alcoa stock was already down a lot though, so I don't think it mattered what they said. Let me see what it did today. Down 2%. Yeah, but Alcoa was already down like 40% from the top. So yeah, who cares? Alcoa wasn't gonna do anything bad. We need some more better results here from other people. So let's look at Steel Dynamics. So STLD will be Monday after the close, and then we have Halliburton, Tuesday. Okay, that will be important. I got to hear what Halliburton has to say. And then we have DR Horton. So that's home building. Yep. DHI, that's going to be important. I got to hear that because home building sector is also a sector that could be improving. So we're going to see what DR Horton says. And then we have GE Vernova. That's my favorite. GE Vernova on Wednesday morning. And then we have TE connectivity. That's kind of has something to do with the AOI, coherent Lumentum people. And then we finally get to the big boys. IBM already reported, right? They already had a surprise earnings. They said, like, oh man, our earnings are so bad, we have to tell you ahead of time. Well, you told us ahead of time. So we got the bad news from IBM out the way. IBM is out of the way. They're going to have the conference call on Wednesday, but I think the market already knows how bad they are, so they're not going to freak out anymore about IBM. So that's not a problem. ServiceNow will be one of the big software companies that we'll have to listen to. So NOW Wednesday after the close. Google after the close. Tesla after the close. Texas Instruments TXN after the close. So those will be important. And then what's happening Thursday? Nokia before the market opens. ST Micro before the market opens. STM and Nokia NOK. All right. So Wednesday to Thursday morning, we will have something, okay, before Intel reports Thursday afternoon after the close. We'll have enough stuff before Intel to rock the markets. And I don't know why there's so many dark pool activity going on in Nokia and STM right now, but somebody is trying to get shares behind the scenes, and it's getting me very curious about Nokia. I'm very tempted to buy Nokia stocks right now or STM stocks right now because of that. So yeah, this is gonna be the first time I'm gonna be looking at these dark pools and going like, is it worth studying the dark pools? Because now that 50% plus is hidden volume outside of the market exchange. So that's why we have to look at this stuff. Is that what we have to do here? We have to study dark pools now. So if it does work out, then I might have to study it some more. Have to learn how to use it. So that's why I went into all that dark pool talk in the past streams. Okay. All right. Okay, that's it there. So let's get back to where I was here. So, like I said, the relationship between high beta and low volatility ETFs, we see that we have a drop, okay, so far of 13.5%. This is very significant drop because we already seen a 16.9% during July of 2024 during the yen carry trade. That killed a lot of the semiconductor stocks. Um, and then we also had the 10.92% drop going from January into the Iran war. So even before the Iran war, people were rotating out of software companies, right? And semiconductors were going sideways. So that's what caused this one. And then the tariff trade was the big 28.67%. The last time we had something more than 20% decline in high beta versus low volatility was the 2022 bear market. So I doubt we can go past like 15%. So we're either at the bottom or close to the bottom right now. And the only way that we would know that this is a true change in trend would be if the earnings, the Google, the Intel, ST Micro, Texas Instruments, Nokia. I mean, you already saw it, right? Tesla. That's all we have right now for next week. Are any of those going to crash it? That's what we're waiting on. So we already declined a lot from the top, right? So all the things that were leveraged are gone. That's what we're talking about here. The leverage that we're seeing here is gone. That's what we're seeing. So we had the U.S. momentum drop. This is from the Goldman Sachs data. We already talked about the Morgan Stanley. This one down, let's see, 34%. It's worst monthly decline in 17 years. So this is the Goldman Sachs U.S. high beta momentum index. Okay. So it's down 23%. The worst was 34%. We're close to, the worst case, which was during the great financial crisis, I guess, sometime in 2009. So this was probably the final bottom. Maybe that was during the final bottom of the 2007 to 2008 bear market. It took about like over a year, right, to finish that whole bear market, 1 to 2 years. So that was probably the final breakdown. So we're already here. We're already here. A lot of these stocks, you could say, is already in a bear market. So there you go. I think, yeah, we should be looking to buy the dip. As crazy as that sounds, that's crazy. I avoid the dark pools. Oh, you avoid the dark pools. 35% on Oracle calls today. Oh, you got an Oracle? Well, uh, Michael Burry closed his shorts. Michael Burry has closed his shorts. That's it. That's it. Yeah, that's it. I used to use Upwork. Never again. Can't stand freelancing. I want steady income. Okay. Yeah. Yeah. Yeah, I think we're gonna be good. So, yeah, I would be probably starting to get bullish, man. Yeah, that's where I'm getting heading towards. I'm feeling bullish. I'm feeling bullish. Yep, 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 yep. Oh, that's crazy. So here we are. Let's get back to China. Let's wrap this up. I can only talk about a little bit today because, yeah, I'm not gonna have much time. And this one's a long blog post. This one's a really long blog post. So I doubt I can get through this in 10 minutes, 15 minutes, whatever. Okay, let's see. See how long I'll get through this. So this was written in February, but he retweeted this. So he retweeted this yesterday. He was saying, like, read this blog post. Please read this blog post. That's what Michael Burry said. So Hong Kong stock structure and strategy. Hong Kong stocks are in the dumps and have been there for some time. This was not always the case. I know, I was there. I started investing heavily in Asia in 2003. By 2005, I had a couple Asia funds and a fully staffed office at One Exchange Square in Hong Kong. Not exactly a side gig. I was all in on Asia simultaneous with being all in on $8.4 billion of shorts on doomed corporate bonds and RMBS. What is RMBS? Is that renminbi something? Um, let me see. Let me see. Let's see what that means. What does that mean? Okay. RMBS. Let me specify China. What is that? Oh, okay. So in China, RMBS refers to residential mortgage backed securities. All right. So that's the mortgage backed securities of China. All right. My side gig was sleep in those days. Still true, but different. Okay. UBS Greater China Conference 2005. The UBS Greater China Conference was a notable one, as it was before the companies we are discussing today were known. Society had not changed that much, yet I was still excited by what I saw and heard. Going over the list today reminds me that the China that I knew then is not the one today. The only 2005 public stock we are discussing today is Tencent. Oh, Tencent, 40% ownership of Discord, which did not participate in the conference. Baidu was there as a pre IPO pitch. Baidu is the Chinese YouTube. The rest were all the important, or I mean, Baidu is the Chinese Google. I don't think they have a YouTube with their Google, but Baidu, yeah, is the Chinese Google. The rest were all the important businesses to an economy other than tech. It seemed there were more than those then. Still, I believe the vibe was more entrepreneurial than even my Silicon Valley hometown, and not by a little bit. I wrote about a visit to China and Taiwan in a 2005 letter to investors. You can see I believe there was tremendous opportunity. I'm not going to read this. This is too much. This is too much. Okay, okay. From the time I had read, from the time I had first started investing in China in 2003, after a SARS-CoV-1 epidemic pushed Hong Kong's Hang Seng index to lows around 8,300, I realized something was special was happening in Asia. As an aside, our recent epidemic was SARS-CoV-2, also a coronavirus originating in China. By the end of 2007, the Hang Seng had rallied off those lows to 31,000, 275% higher. So in 2005, it felt really high to be in Hong Kong, in China, looking for investments. China was on the up, and even though I saw the build it and they will come future Ghost City business plans in a Shu Onlan penthouse office in Shanghai, no less, I was optimistic. I was also in Hong Kong when Tencent hit $6 Hong Kong. Yes, six. I owned it. We were all watching it. It was a buzzy company with a known good management team, and the company had QQ, a very popular chat messaging platform for PCs with over 350 million registered accounts. QQ is like Instant Messenger, AIM Instant Messenger, or Skype. It was kind of like that. That's what the Chinese were using back then. That was fed. That base fed Tencent's 2005 explosive introduction of its own MMORPG games for PC. Tencent's mobile phone operations at the time were in decline. The company provided technical support to China Mobile's 161 chat, and it had two rudimentary chat services: Fengchang's QQ Nanu and QQ Xiaoyuan QQ Campus, targeting students, which smartphones would soon kill. All right. Okay. By 2011, WeChat liberated Tencent from a telecom revenue sharing chokehold, and the rest is history. Good for Naspers. What the heck is Naspers? Unadjusted for the 2014 5-to-1 split, stock split, that six Hong Kong dollar stock will be worth 2,610 Hong Kong dollars today, a 35.1% compounded annual return the last 20 years. Very good. So I could not stick around for that. By late 2006, Scion Capital was struggling to make it to the RMBS CDS finale. So I guess he was shorting these mortgage backed securities in China. In December 2006, I flew to Hong Kong to close the office there and fire everyone. I rank it with my divorce and my dad's death as the three worst plane flights of my life. Uh, the Asian funds closed soon after. Long-term owners of Tencent would not have experienced a steady rise nor a smooth parabola. Below is a linear chart of Tencent from its 2004 listing to present day. So this is not log scale. This is arithmetic linear scale. So I guess Michael Burry was around here, right? 2006, 2005. And then all the way up until 2010s, he probably was like, oh, okay, well. But since those days, look at it. It's just going crazy. Up and down. Looks like a lot of volatility in the latter half of the period. Now, let's look at the logarithmic version of the chart. On a log scale, equal vertical distance equals equal percentage of return. This better tracks the experience of an owner of a compounder over a long period. All right, doesn't look that bad now, right? Well, for Tencent anyway, one looks at it, it was a heck of a long-term performance. Tencent has beat 99.9% of all publicly traded companies in the world the last 2 decades. During that same time period, only 4 US-based stocks beat Tencent's compounded annual growth. Nvidia at over 40%, Netflix at 36%, Monster Beverage. Yes, Monster Beverage is a great stock. That's true. That's true. People love energy drinks, 40%, and Broadcom at 35%. In the last 10 years, Netflix, Broadcom, and Tencent all increased revenue between 4.5 times to 5 times. Mm. Okay. Broadcom and Netflix have been leading performers, but Tencent stock has almost exactly a 0% return over the last 5 years. This is the problem. All of Hong Kong's massive tech stocks became massive since 2007, and the Hang Seng is today 27,000, 15% lower than 2007. Most of Hong Kong's largest tech and media companies have been dead money or worse for years. Investor sentiment toward China and Hong Kong the last 5 years was unthinkable in 2005. There were catalysts for this malaise. In October 2020, Jack Ma publicly bristled at perceived suppression of innovation in China. This offended Beijing, which within 10 days, Alibaba's planned IPO of Ant Group was canceled, and Beijing launched a 2-year regulatory crackdown on China's entire technology sector. The Peking Hang Seng found no succor as the property market teetered into an epic descent and COVID erupted from China and ran through China's customers. Then came 3 years of lockdowns, a tough time. Below, 9 leading companies since November 30th, 2020. So there you are. If you bought Chinese stocks during that period, you went nowhere. You went pretty much nowhere. From 2024, there was a decent recovery off lows. However, recently, Korea is experiencing a renaissance among investors sniffing out the country's AI chip expertise. Japan has a new prime minister and is getting a fresh look. The United States market is near highs and has the world's attention with AI. So funds are fleeing the Hong Kong stock market, and most Hong Kong stocks have turned down of late. Let's look at some of the larger ones below, ranked in order of performance. BYD, yeah, I like BYD too. Um, I don't know if it broke out yet. Let me look at this chart right now. Man, I think in 2024 I mentioned BYD as a potential breakout candidate, but I don't think it successfully broke out. BYD makes a lot of your lithium ion batteries, and they also make cars, electric cars for the Chinese market. And I think they're going to move into the European market and possibly the US market down the line. So let's see, BYD. So BYDDY ETF, not ETF, OTC shares. Okay. So this month so far is up 22%. Last month it was down 20%. Hmm. Maybe. Maybe I have to look at this. Maybe I'll have to look at this again. All right, so BYD. Okay, yep. Next one, Tencent. Okay, Pinduoduo. If you ever use Temu, then Pinduoduo is the company that owns Temu. Kaisho, I don't know if any of you guys used anything that Kaisho has made. Alibaba, you've definitely heard of Alibaba. Baidu is China's YouTube. Halidiao, I don't think you guys know that. JD.com, kind of like a competitor of Alibaba in a way. Meituan, I don't think any of you guys know any of that. I think they make some cell phones. I don't know. That performance is after pretty good bounces off lows. So you see the same list here. These companies deserve a evaluation, a deep look into vulnerabilities, virtues, and value. First, we must take a considerable detour and fully examine a vulnerability that applies to almost all these stocks. For all the above but BYD or Haidilao, the actual shares bought by investors are shares of a Cayman Islands shell company with no operations. That shell company is the first link in a chain that ends in a Chinese variable interest entity VIE structure designed to skirt China's law against foreign ownership in certain media and technology industries. A good number of investors avoid Chinese stocks because of this VIE structure. You don't own shares in the company, they say. A statement more loaded than they may know. So that means you can't vote for these shares for sure, right? And yeah, you don't have any control over the company. Other gloss over the risk, arguing China would not screw foreigners who provide capital, or just imagine it is a common risk, so not one to worry about, even if the risks is binary and irreversible. This is called normalization of deviance. Diane Vaughan, a sociologist, described repeated exposures to risk without consequence reducing a population's perception of the severity of the risk. A risk may remain severe even as people habituated to it. In our case, the population that has normalized risks of a deviant VIE structure includes many of the world's most sophisticated investors. Those that have not habituated to the risk likely still do not understand the nature of the risk or do not have all the information. I am to educate, so here is the full Monty on Hong Kong VIEs. And you have to pay money to read the rest of it. So I got through it. So I guess if you pay money to Michael Burry and unlock this article, he will tell you how to buy Hong Kong stocks safely. Well, I can't tell you how to do that. And I'm not going to open a brokerage account in Hong Kong just to buy Hong Kong stocks. Okay. If I have to buy Hong Kong and Chinese stocks over here, then I'll have to deal with the risks of buying it over here. But like I said, I'm not here to buy Chinese stocks as an investment, but I definitely will buy Chinese stocks as a trade. So they're very good for trading. All right, Burry is apparently bullish on DraftKings. Chart looks kind of ass. Well, Burry's not a technical guy. He's all about like trying to figure out some deep fundamentals that the market doesn't see, right? So he's a contrarian investor. He's a contrarian bettor. He's always interested in finding something that he thinks the market is stupid in, right? So if he thinks the market is stupid, he's going to go against what the market is saying. So I doubt he ever looks at the charts. He doesn't believe in that stuff. So he's always going to try to look for some mispricing in the markets to take advantage of that he feels like he's seeing something that you don't see, that the market doesn't see. All right. So I'm done. Tomorrow I'm going to have to try to do 2 streams, okay? And we're gonna have to make them each 2 hours. All right, so I'm gonna do 4 hours of streaming tomorrow because we have to get to the sunspot stuff. What else was I supposed to get to? I forgot already. Oh my god. Oh, there was something else that we have to talk about, and then we have to go through all the Demark things too. That's another thing we have to go through some Demark analysis work for the earnings next week. That's what we're gonna have to get through. Anything else I forgot about? No, that's it. I'm glad I got to the Michael Burry article. Yeah, good. Oh, the AI. Yeah, that's what I was thinking about. The AI pricing. Oh man. Yeah, we have to get through that video, the final part of that video with the AI stuff, pricing, and maybe research some of the Chinese AI models versus the US. I don't know if we'll have time to like get through that. Maybe I'll have to do that some other time, but that'll be important. Have to be important to look at. Okay. But yes, we have had the largest drawdown in high beta to low volatility momentum stocks since 1999 or even of all time. Okay. Where we've had like this divergence in volatility. So we are in unusual market. We are in an unusual market moment. So either the semiconductors will rally back up and continue on, or we're going to have to take that money from semiconductors and go somewhere else. Where is that somewhere else? Well, wouldn't you like to know? I would like to know as well. So we'll see. All right. Good night, folks.